Welcome to Fireside Chat. My name is Sai. I want to dive deep into step 6 of the FIRE checklist, which is to max out your Roth IRA and HSA, but specifically the Roth IRA when you're on the Fat FIRE journey. The common misconception is that you can't contribute to the Roth IRA if you make too much money, but there's actually a way around it. Congress tried to repeal this process last year with the Build Back Better Act, but the bill is now pretty much dead. This video is especially for people making over $144,000 a year if you're single, or making over $214,000 a year if you're married and filing jointly during 2022. Backdoor Roth IRA is not a separate account, but a legal way to get around the income limits that prevent high income earners from contributing directly to the Roth IRA. Let's emphasize the legality of doing backdoor Roth IRA. So tax evasion is against the law, but tax avoidance is completely legal. Backdoor Roth IRA is not a tax evasion or tax avoidance. In fact, you actually pay more in taxes now, so you don't have to pay taxes later when you retire. Something else to keep in mind is that if you're under the age 59 and a half, when you convert your money from traditional IRA to the Roth IRA, you have to wait at least 5 years to withdraw your conversions from your Roth IRA free of penalties and taxes. The rules for the conversions are different from contributions and earnings. So in this video, I want you to pay attention to the 3 words: contributions, earnings, and conversions. So the IRA contribution limit is $6,000 if you're under the age 50 or $7,000 if you're over the age 50. When you contribute $6,000 to a traditional IRA and then convert that $6,000 to a Roth IRA, you don't owe taxes on the $6,000 because it's a non-deductible contribution. This is where you need to be careful. You want to make sure that you leave that $6,000 in the money market fund within the traditional IRA so you don't accrue any earnings. Because if you invest it in the traditional IRA, then you will have to pay additional taxes on any interest and earnings you make inside a traditional IRA. Let me break down this process for you even further. Step 1 is to open 2 accounts, traditional IRA and a Roth IRA. Typically, this step will take you about 2 to 3 business days depending on the broker you use. My wife and I have Vanguard, Fidelity, and Schwab, and they're all excellent brokers with index funds. The broker will also need to verify your bank account that you're going to make contributions from and your identity. So you can apply to open both traditional and Roth IRAs on the same day and get your bank accounts verified at the same time. It will take about 2 to 4 business days to verify your bank account because they're going to make 2 small deposits to make sure you're the owner of the bank account. Step 2 is to contribute to your traditional IRA from your bank account. You can either deposit all $6,000 at once or dollar cost average however much money you want. Typically, I see people doing $500 a month or $230 every 2 weeks. It's completely up to you. When you contribute to your traditional IRA, you want to make sure that it is staying in the money market or cash account so you don't accrue any earnings. By the way, if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. Step 3 is to convert what you contributed to the cash account inside your traditional IRA to the cash account in your Roth IRA. If you contributed all $6,000 to the traditional IRA and you convert it to the Roth IRA, that $6,000 becomes a conversion and it is no longer a contribution. You see what I'm saying? That you contributed to the traditional IRA from your bank account and then you convert it to the Roth IRA. Now, you may see a warning or caution that saying that conversion is a taxable event, but it is not. Let me explain why it's not a taxable event. The government can't tax your retirement savings twice. What you contributed to the traditional IRA from your bank account is already taxed by the government. Since you already make too much money, the contribution you make to the traditional IRA is considered a non-deductible contribution. You need to make sure during the tax season you annotate your contribution to the traditional IRA was non-deductible on Form 8606. You will also get an IRS Form 1099-R from the broker that you distributed $6,000 from the traditional IRA. Form 8606 will offset from the 1099-R so you don't pay any taxes on the conversion. For example, if you contributed $6,000 to your traditional IRA and you earn $1,000, then you distributed $7,000 to the Roth IRA altogether. Your Form 8606 will say that your non-deductible contributions to your traditional IRA was $6,000, so then you would only pay taxes on the $1,000 that you earn. So I hope that makes sense. If none of this makes sense to you, just hit rewind and watch it slowly or contact your CPA. It took me a while to understand it too. And then step 4 is to start investing in stocks, bonds, ETFs, or mutual funds inside your Roth IRA. This is where your tax-free growth begins. However, you have to remember that you can't withdraw the conversion you made for 5 years. This is what we call the 5-year conversion ladder that I talked about in another video. Any earnings that you make from the conversion you made will have to wait until you're 59.5, or the 10% penalty and federal income tax will be added on. So let's summarize this. You can contribute up to $6,000 or $7,000 if you're age 50 or older to your traditional IRA, and make sure it's in a cash account so you don't accrue any earnings. You can convert your $6,000 or $7,000 to the Roth IRA, and then you can buy securities within your Roth IRA to start accruing earnings so they can grow tax-free. Just keep in mind that these 3 words, contribution, earnings, and conversion, all have their own IRS rules. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.